LWBJ, which is now actually UHY, correct? Okay. So he is a CPA here in Des Moines, but he has a lot of experience, particularly whether it's on the CFO side. He's an advisor. He's on multiple boards of different startups or businesses. And today he's going to be going through the capitalization table, which is essentially this ownership table. And he's really going to do walk you through what that looks like as you take on money. So definitely listen in, and I'll, with that, let you take from here.
Great.
Thank you.
Thank you. Again, J.D. Janizer, LWBJ, now UHY, I'm a senior partner. We are a traditional CPA firm, but also an investment bank. I work with a lot of early stage companies on capitalization efforts. Been involved in the capitalization area of Des Moines and in this region for over 15 years. Member of Plains Angels, I'm a partner in Mango Seed Investments, so I'm also an investor. And then obviously we work with a lot of companies all the way through their life cycle and then move into M&A, sell-side advisory, everything. 90% of what I do is transaction related. You can read the bio. So today, what we're going to do is go through some, I guess, common terms, some vernacular around the cap table, and then we're going to actually get into some complex, I'm trying to keep it at a high level, calculations and kind of the impact of capitalization, bringing capital on, dilution, etc. So what is a cap table? Basically, it's a list of the securities of your company. It tells you who owns what of your company. Very, very important to always keep it current. There's no right or wrong way to have a cap table formed. I mean, I do a lot of cap tables in Excel. There's a lot of good software packages out there to maintain your cap table. The most important thing about your cap table, it's got to follow your organizational documents. I mean, anytime there's a security issued by your corporation, there's documents pertaining to that. And those documents have to tie into what you're showing as a representative example of who owns what of your company. And again, it's a powerful planning tool. And we'll kind of walk through, it allows you to run scenarios, etc. Also very, very interactive. I'm going to throw some calculations up here, so just very interactive. I like to be interactive. So. Again, keep it current at all times. Any investor is going to want not only your underlying documents, but your cap table, making sure you understand your cap table, what investors' rights are, all the documents. We step into a lot of companies, and it's not a unique situation where an early stage company and they're not up to date. Some of the documents aren't there. They had a developer that was supposed to get 5% of the company, or et cetera, et cetera. A lot of them are well-known companies that you're probably aware of, that we have to say, okay, let's get everything cleaned up before we even start to go and talk to investors, because the first thing that an investor wants to know is make sure you're organizing your documents and organized. And so we try to get you on offense versus defense initially to make sure you're really ready to take on capital. Again, it allows you to run scenarios, pre-money valuations on new financing, future rounds of financing, looking at dilution impacts on different sizes of financing rounds. And then even specifically to employee options and incentives for your key hires. Common terms. Corporations issue shares, LLCs issue units. It's basically a common basic form of ownership. It's just more vernacular. Rounds, you hear series of rounds, you hear a founder's round. A founder's round is really just that. Maybe founders have formed a company together, maybe somebody's contributed IP or a tech stack, or somebody's contributed some capital into it, or just the idea, they get formed and basically form a company. Again, sometimes there is capital involved. Friends and family, exactly that. They're really investing in the relationship versus the company or the idea. It's really just a personal relationship that they're investing in you. Seed is usually the first outside money you're going to bring in. It's early stage investors. Sometimes there's seed individuals that do seed investing. A lot of times there's some smaller seed funds. And again, most of the time a seed fund is not going to drive as onerous terms as a series, like Series A, B, et cetera, and all that is just, again, the chronological path of a round. Usually when you get into Series A and beyond, it's institutional investors, more sophisticated investors, probably driving a little bit more onerous terms, preferences, et cetera, on you. But that's usually a lot larger round, too, when you move up from the seed stage. So pre-money, post-money. Pre-money is just the valuation you put on your business prior to a financing round. Post money then would be the money after that financing round's been completed. If you put a pre-money valuation of $4 million on your company, you raise $1 million, your post-money valuation is $5 million. Some quick math again, if you raise $1 million at a pre-money of 4, your post-money is $5 million. So that $1 million investment into the post-money valuation of $5 million represents a 20% equity stake in your company. Recap, down, you don't like to hear it, but it happens all the time. Any given time we're working with a few clients that are going through this, and all that means is basically you're raising capital at a price, a pre-money valuation, if you will, lower than the prior round. And sometimes there's reasons for that. Sometimes valuations get too high initially, but the company's still on a good trajectory. And sometimes there's economic challenges, product challenges, whatever that basically forces you to go back to the market at a lower valuation. So it's a dilutive impact, but a lot of times the best thing that we've seen happen for a few companies is to have a recapitalization, get the capital they need and go execute again. It's kind of almost a restart sometimes. Options and warrants. An option and a warrant is just simply giving the holder of an option or warrant the right to purchase stock in your company in the future at today's price. And we'll go through an example how an employee option can be triggered through a sale process. Preferred and common, it's just really preferred is a class of security as well that really just has specific rights over the common shareholders. Sometimes it's economic rights, sometimes it's voting rights. One of the main rights you'll see a lot of times, we'll talk a lot about today, is a liquidation preference, meaning I get my money out before the common shareholders get their money out, or any other investors as well. And there's multiples on liquidation preferences, et cetera, that we'll talk a little bit about, but that just means I get paid before you get paid. And a waterfall analysis is just basically the analysis of a transaction or liquidating event and how the proceeds of that event are distributed to the shareholders. And you'll find through this scenarios that we'll walk through, the proceeds distributed to the shareholders don't always follow the percentage of the shareholders own due to preferences, etc. Accredited, generally, accredited can be defined as an institutional investor, but generally it's used in terms of it's an individual that meets a high net worth test. A lot of times when you're raising capital and you only allow accredited investors, there's security exemptions, et cetera, so it is an important hurdle. Most of the time in the subscription agreement or the documents they're signing to invest in you, they acknowledge or have to basically sign that they are an accredited investor, meaning that usually it's also acknowledging they're big boys and girls and they understand they could lose the investment. Friends and family we've already talked about. Angel, again, is just another definition of a high net worth investor. Seed funds, early stage funds. Family offices are unique. We're seeing a lot more family offices getting into early stage investing, and that's just really a high net worth family or a group of high net worth families that have retained professional management to help them invest in private investment. Institutional venture capital, again, that's usually the bigger boys and girls that will come in, write bigger checks, and basically probably drive a little bit more structured terms for the investment. Yeah, I'm sorry.
What do you recommend the entry point for family offices would be? Through that investor, through the person they hired, directly?
The entry point to a family office?
Yeah, and who am I ultimately pitching to?
Generally, it's the investment professional that's retained by the family office. They usually have a team.
Carte blanche to those people.
Yeah, I mean, generally there'll be a managing director in there, and if the higher you get into an introduction, the better off you are. There's usually analysts underneath that. Some family offices just have one professional, that works for them. Family offices vary, it's all the way through, through billion-dollar families, all the way through a consortium of people of like mind that retain a professional to help them do alternative investing. But generally at the professional level, I wouldn't disrupt the family in that process. It's usually whoever the professionals are. And most of the time you can navigate that through websites, et cetera, and understand who the professionals are there too. And again, we've seen in the last 5 years a large ramp up of family offices, meaning that basically high net worth families are looking for alternatives for investment purposes and getting into private companies. Okay, so right after lunch, we're going to have you do some math. So And I apologize for that, but we're gonna, again, and I also apologize, we're gonna try to keep this at a highest level as we can, but explain as much as we can. And I welcome the opportunity to be individually with any of you on Excel spreadsheets to walk you through all of the what ifs and be able to make changes, and you can see all of that. But that's not gonna happen today, but we are gonna take you through some of that. So we're gonna have a fictitious company. We're gonna go through 5 rounds of capitalization. We're gonna show each round's impact on ownership percentages. And then after that, we're gonna present 3 different exit scenarios and how that impacts those same exact investors that are on that cap table at the same time. So, we got 3 founders of SaaS Systems, Amy, Bill, and Chris. Each contribute some capital and some intellectual property, and each is issued 200,000 shares. There's nothing magical about 200,000 shares each. It could be 20,000 shares each. It's just what they've determined. We'll talk a little bit more about that. But they're each issued 200,000 shares. Again, they retain a good attorney that creates the organizational documents, and they issue the stock certificates. So, this is the first cap table for SaaS Systems. Amy, Bill, and Chris each own 200,000 shares. So Amy has 200,000 of a total of 600,000. So Amy has 33 1/3%. It's just as simple as the 200,000 divided by the 600,000. This is the most simplest form of a cap table. It's just a listing of who owns what and what percentage they hold and all that. I've seen cap tables with no percentages on them. It's just, hey, here's the total list of our shareholders. So they start product development for several months. They decide they need to bring some more resources on. They further decide they want to create an awareness program, get the market aware. So they decide to raise $250,000 from friends and family to complete the development of the prototype and, begin kind of the initial market awareness of SaaS systems. So a few things they do, which they needed to do, is put together some financial forecasts, a presentation, a little, basically, articulating what the business plan is, what their growth strategies are, how much capital they need, et cetera. Even though they're early stage, they feel, their product suite has a significant opportunity. So they establish, out of the blue, through the dark, $1 million they're worth today. And the great thing about friends and family is, after multiple meetings, Uncle Charlie decided to invest in that valuation in the company and write a $250,000 check. So, and it's always Uncle Charlie that comes in first. So, and again, Uncle Charlie probably didn't do a lot of diligence, but he knows Amy, he trusts Amy, he believes in Amy. Math. And this is where we're going to get into it. Can you all see this? Okay. Because it's important that you can. So here's where we were, right? 600,000 shares outstanding. So if we're going to put a valuation of the company today at $1 million, pre-money valuation, before we take any money in, that $1 million then divided into the 600,000 shares gives me a price per share of $1.67. Calculated down here as well, right? So I haven't taken any money in. My business is worth $1 million. Because Uncle Charlie agreed to it, it's $1 million. And I have 600,000 shares out. So Uncle Charlie is going to buy shares at $1.67. Okay? And here's that math right here again over here in our cap table in the formula. So Uncle Charlie's going to write a $250,000 check divided into $1.67. He's going to get 150,000 shares right over here. Okay? So we go from 600,000 shares to now 750,000 shares because we issued Uncle Charlie 150,000 shares. So a couple of different ways to look at the math, but basically 150,000 shares of 750,000 shares is 20% of the company. Said another way, 250,000 now at a post valuation of 1.25 million represents 20% of the company. So Uncle Charlie now owns 20% of the company. And all we did is some simple math. Basically said, our business is worth $1 million. Okay, so how many shares do we have outstanding today? We'll divide that into $1 million, and that's our price per share that Uncle Charlie's going to write the check for. Questions?
How did you get the number of shares that he was going to get?
Well, let's talk about that. I mean, again, the numbers, I'm glad that's back there. You guys can see that. I didn't know that.
Because I see the 20% I get.
So you want to know how I got the 150,000 shares?
Yeah.
Okay, what's Charlie writing the check for?
250.
And what's the price per share?
167.
What's 250? What's 250,000 divided by 167? It's 150,000. Okay. And I will say this too, for everybody, these are all rounded to the nearest decimal. You might be getting different, little bit of different numbers. This is all rounded, so the math might be off a little bit if you try to actually take it all completely out. But that's the answer, right? The math told us, because we know how many shares we have outstanding. We know what Uncle Charlie's agreed to value the business at today. So before Charlie even writes a check, we got to set a price per share.
So just to confirm, even though there's a different pre-money and post-money valuation, the price per share isn't changing. Like, does it change ever?
Let's go through that, because I was at $1 million at 600,000, right? Okay, now I'm at, Charlie wrote 250,000, right? And now I have 750,000 shares. The price is still $1.67.
Gotcha. But does it ever change, I guess is what I'm asking?
It can. It can, yeah. Because when we get increased valuation over the same amount of shares, we'll take you up that and show you that piece. And then sometimes it can be impacted, but it can be diluted a little bit. We're going to show you next on an option pool, because there was no financing event. But on a fully diluted basis, you might have more shares out there. So to that point though, right now, we're still priced at $1.67 a share. And all we did is some quick math. And basically, the most subjective thing we did is get Uncle Charlie to agree to pay, to value the business at $1 million. Okay. The founders identify a key hire, so we're going to get into something else here. She's not going to join the company without some equity incentive, and you probably all experienced that, or you will experience that, right? And there's different times when incentive pools are getting formed. Sometimes it's a lot of times before institutional investors come in, they'll say, hey, get the option pool set up and all of that. Anyway, they go through this process. They hire their attorney to get a stock option plan put together. They decide they're going to allocate 10% of the ownership off the existing. So there's 750,000 shares outstanding after Uncle Charlie. They want to add 10% post of that, of an opportunity for an option pool. The key hire joins the team and receives options. So let's just look at what we did there a little bit. All we did is did a circular formula. We had 750,000 shares. We kind of played a little bit back and forth to get 10.18% represented 85,000 shares that we issued. So now, those 85,000 shares really aren't necessarily owned today. Some of them have been issued as an option, and the plan is that the rest of them would go to key other hires. What that 85,000 does represent, though, is the option of these key employees to buy shares in the future at today's price. So on a fully dilutive basis, we put them on the cap table, which really impacts pricing and everything else. But on a fully dilutive basis, now we have 835,000 shares outstanding. The reason that's disclosed is for an investor to understand, if we would have just showed 750,000, we wouldn't have been giving them a true insight of what the total potential ownership of the company could look like over the years. So that's why the option pool is added. And we could spend an hour talking about options. So I won't. Okay. Everybody tracking with me so far? There'll be a quiz afterwards. Okay, so technical issues with the product persist a little bit. They made significant progress, but they're running out of money. They have a staff of 5 now, and they decide, hey, let's go get a seed round of financing. Through an exhaustive process, could be even a few months. Plains Angels agrees to put 500 grand in at a $2.5 million valuation. Remember when Uncle Charlie came in, we were at $1 million pre, and he put 250 in, so we were at a post of 1.25. Now, Plains Angels, because they've shown enough traction development, maybe they've explained the market opportunity, they're putting a pre-money valuation of the business at $2.5 million or a post of $3 million. So this is obviously going to impact our price per share. Some more math here. So remember, here's where we were. This is just after on a fully dilutive basis, and I'm going to price these on a fully dilutive basis. There's some ways it can be different, but on a fully dilutive basis, we have 835,000 shares. So again, if the pre-money is 2.5 million, what do? I take the 2.5 million divided by 835,000 to arrive at $2.99 a share that Plains Angels is going to pay for their $500,000 investment. And that's going to result in 167,000 shares. So now I have 1,002,000 shares outstanding. Plains Angels has 167,000 of those. So 167,000 divided into the 1,002,000 shares represents a 16.67% ownership in my company. And the interesting thing now is the owners, the founders, have gone from 33 1/3 to approximately 20% each, but they've raised $750,000 and have an option pool in position. Questions?
I have a question. As far as how do you determine a person's contribution? You know, what sort of allocation should each founder get? Or should those the allocation be different based on what they contribute?
It should be different. I mean, a lot of times founders will come in, there'll be a 70-30 because somebody's put significant capital in or technology, they want to bring somebody else in to co-found with them. This was just more of a blended, all three getting the same. But you know, that's candidly also more art than science with regard to the formation of the company and what you can negotiate with your group of founders. A lot of times we've seen situations where a founder will come in and have 100%, and then as they're starting to get the beyond idea phase, they find somebody they bring in, they issue them 10%, 12%, 20%, and all that, and they're still somewhat deemed founders and all of that. So that can vary. Yes?
If Charlie came in and didn't want to get diluted, is there a way to just issue more shares to Charlie?
Thank you. Yeah. A lot of times, maybe Charlie wouldn't have had it in the friends and family round, but a lot of times there's what's called pro rata rights, where Charlie could co-invest to keep his percentage. Okay. What can't happen, we've seen instruments that are out there that say that you can never be diluted. And a lot of times I'll get an early stage company and say, well, Uncle Charlie invested in, and we agreed he'd always maintain 5%. Well, that 5% is going to come out of your founder shares because it's, Charlie is going to get diluted, or you're going to get further diluted for Charlie. So most of the time, there's not dilution protection. There is in some scenarios, but for that, what we didn't show here is the pro rata rights, that they could come in and keep their ownership percentages. Did I answer that question?
Yeah, what would Plains Angels say about that? Presumably the entire sell to them if they know that.
Well, again, a lot of times they would already know what that was in the offering document, right? And they would understand that. And I will tell you this, said a different way, when I invest or I bring investors to the table and existing investors on that cap table or in that round investing, that gives you comfort, right? So, in other words, the history throughout, and if that history throughout, those ownership members want to continue to invest in the company, that gives some type of a validation for the external parties coming in as well. So yeah, I didn't show pro rata and all that kind of stuff. I'm going to get a lot more detailed on a few things and give you a headache, but I didn't do that one. Okay, everybody's tracking now. So evaluation of the company now is $3 million because we priced it at 2.5. We brought in 500,000. There it is. There's the 299 pre and there's the 299 post valuation of the company after Plains Angels came in. Okay, so products completed. They're real. They're actually they've analyzed revenue in excess of $1 million. And this is where now growth, man. They got to put the pedal to the metal. So they had 14 people on board and they need basically substantial capital to grow. But they got validation, right? People are buying it. Hired advisor and launched Series A round. After 4+ months, you could say even longer sometimes. Raising money is a pain, as you guys probably all know or will know. They meet with venture capital firms, all this, and our good firm, VC Ventures, decides to offer a term sheet. Basically, $2.5 million of preferred stock. And we'll get a little more detail as we go what rights that preferred stock has. But it has 10% dividends, and on a non-compounding basis, so that means 10% annualized dividends. And that money, dividends always come out before any shareholders get any money out of the transaction. But check that out. They priced it at $7.5 million pre-money. They do have a liquidation preference of 1x. All that means is they get their investment out before anybody else, and we'll go through what that means and how that can impact you. And there's governance restrictions and all of that. You're going to get into part of these scenarios in the future, you're going to see, you know, terms matter, and so Joe Leo does a really good job on the term sheet too, but you're going to get, you know, the term sheet's a lot more important than just your valuation and the amount they're going to invest. So underneath that, they've got some governance restrictions and liquidation preference and 10% dividends. Okay, so now we kind of lost the founders around here because it would get too small. But basically what we've done here now is we've gone from $2.99 a share to $7.49 a share. All I did is, again, take what's the pre-money, $7.5 million. How many shares do I have outstanding on a fully diluted basis? 1,002,000. 7.5 divided by that is $7.49. I'm taking in 2.5 million divided by 749 gives them 334,000 shares. And this math works out, it's 25% ownership, but it makes sense, right? Because I put 2.5 million in at a 7.5, post is 10, so 2.5 million of 10 is 25%. So BC Ventures now owns 25%. Now the founders have raised, you know, what, $3.25 million, and they each still have 15% of the company. And as you can see, yeah, I mean, the options are out there, the option pool's out there, and we're now in the assumption that most of the options have been issued, so there really are, I'm sorry.
What does that mean overall as far as they're taking the company? Is this a dividend that they get? Is this when you sell the company, when you know, if they have a 20% stake versus a 10% stake? How does that all play out, you know, over time for them?
For BC Ventures or for everybody?
Well, anybody who has a stake in, as far as the percentage that they have in the company, it's just equity, or are they actually earning some monthly return on revenue, or?
No, they're generally not used. I mean, sometimes if it's an LLC, there are distributions and tax distributions and all of that. A lot of times it's flow through losses and all of that. Under this premise, no, this is just a private investment. It's a liquid type of investment, so they're not earning necessarily returns. They're investing to increase the value of the company, hopefully ultimately take an exit, or then down the road, to your point, allow for future dividends to come and make it more of a cash flow process. But under this scenario, we're not quite there yet. And BC Ventures did not invest for an income stream. BC Ventures invest to 5x, 10x that investment. They invested at 7.5 at a 10 post to sell at 100 million. So I mean, that's the way the ventures firms are going to think. Okay, so now we have 1,336,000 shares outstanding. We raised over $3.25 million, and this is the current ownership. And again, all this is, you know, at the end of the day, the art is negotiating valuation down here, right? All we're doing is papering everything and documenting and doing simple math to be able to say, okay, this is, and as you can see, before these guys came in, before they did this, I could have made this number anything. I could have played with this multiple times and run scenarios and say, well, you know, I don't want to give them 25%. They've agreed to this. Let's only raise $2 million or something. You can just play with what ifs and see kind of the impact of dilution as you go through it if you've had that, if you've had the structure and such. And again, this is just an Excel spreadsheet. Okay, it happened. Initial traction didn't take place. Many large companies moved downstream with comparable products that moved much faster in the marketplace. They're getting, you know, SaaS, our friends are getting squeezed on pricing, and margins begin to erode. You know, their board's upset. BC Ventures is all over them, calling them daily. They need more money, and to the question we just had, BC Ventures sees a lot of activity going on in that space, and so they want to drive to a potential exit. So, this could be different investment. I'm just investors, and yes, the existing investors have rights to come on with their pro rata shares and all of that. We didn't get into all those details. I just want to really take you through some examples of exits. But basically, BC Ventures comes back to the table and says, they're willing to put $2 million in, but to cut the value of the business in half. So, again, the math's going to be the same, but we went from a $10 million valuation now to a pre-money of $5 million, at a post of $2 million if BC Ventures comes in for $2 million. And it is a common scenario. Down rounds happen. all we're gonna do is the same exact math we did in that far right-hand set of columns. $5 million valuation, we just all agreed that we had 1,336,000 shares outstanding. Our price per share now has gone from $7.49 to $3.74. And VC Ventures is direct $2 million check divided into 374, they're gonna get 534,400 shares and get 28.57% of the company. Now you see what happened to them in their prior investment. Their 2.5, it was 25%, it's now 17.86%. But VC Ventures is doubling down, right? I mean, they now own 46.43% of the company. They put $4.5 million into it. But that's them doubling down and now driving towards an exit. Now, our good founders are just a little south of 11% each. Questions on a down round? They're a lot hairier than that. I mean, sometimes they're not always the friendliest types of scenarios, and generally a lot of times that is when other investors that are already on the cap table do have the rights to come in and protect their shares. So that $2 million was invested in the same terms that VC Ventures invested the $2.5 million. So we got 10% dividends and preferences and all of that. Okay, again, it's just math, but all we're doing is keeping track of everything that's happened through the life cycle of the company and showing it in segments. So,
I got a quick question.
please.
Can you go back a slide?
Okay.
Is control of the company determined by your percentage, your equity stake, or by board seats?
Depends on what is in your shareholder agreement. Seriously, I mean, a lot of times, particularly C corps, there are certain percentage levels of ownership that have to authorize something. We're doing one right now where it's 75% shareholder approval, but we're also carving out a management incentive in front of that, almost a transaction incentive. That requires 90% shareholder approval. So it just all varies. But like VC Ventures, chances are they have governance rights over certain things. You can't take on loans. Maybe they can restrict CEO or founder salaries. All kinds of different things.
Even before the down round, in the first part of the Series A, the founders have already lost control of the company, right?
Yeah.
Now, the reason I ask about board seats is because if, let's say, Uncle Charlie probably wouldn't have had a board seat, right?
We hope not, but we've seen Uncle Charlie on a lot of boards.
So then, but VC Ventures on the Series A, let's say they asked for 2 board seats, if each of the founders each had a board seat, even though they owned less than 50% of the company, they could still technically have control?
Possibly, but generally no. And I will tell you this, it's very, very common when you get to a Series A, B round that the founder does no longer have a 50% control. There's situations where, sometimes companies skyrocket, right, and do. But a lot of times, it's more about execution now and going. What can happen too, and we're doing one of these right now too, is there's additional options issued to the founders or the CEO. There's different ways to continue to compensate them for execution. The last down round we did, there was a carve out additionally for the founder who was still the CEO to incent them to continue to execute and drive towards creating value. So there's a lot of ways that founders get protected as long as a lot of times. At some point, Amy, Bill, or Chris might even been out of the company by now, and that's common as well. It happens. So we're gonna do a good scenario first, and there's some math in this as well. Basically, you got a little bit of traction. VC Ventures is a little fatigued, maybe with the founders. They have an offer for $17.5 million. And remember, we just did a post of $7 million, right? Because we were at $5 million, and there is additional 2 from VC Ventures. All employee options have been issued, and we'll show you why they're going to exercise at this price. So that all of those options will be exercised. And for the simplest math, we're saying the close came approximately a year after the down round and exactly 2 years after the Series A, resulting in accrued dividends of $700,000. So remember, that's additional kicker VC Ventures gets before anybody else gets anything. They get that dividend back before any shareholders get anything. That's just another preference that they have that will lead to disproportionate percentage distributions on a waterfall. So if you know, people think about it, 17.5 million, we just showed you, I did right here now, we have 1.87 million. This shouldn't be a dollar sign, that's shares, but we have 1.8 million shares outstanding right now. So here's ownership of that. So logically, you think 17.5 should be divided on who owns what, right? Well, here it's pretty close. I mean, here the math works pretty good because it's a good exit. But if you go to the far group of columns, we're gonna show you that the employees exercise those 85,000 options. A lot of times that's netted, because here's what happened. That 85,000 options was exercised at $1.67. Remember we priced those at $1.67? That's just simple math too. So they're exercising, and under this we're showing they're actually paying in. But for that 141,000, they're getting $769,000 back in proceeds, and we'll take you through that math. A lot of times this is showed as a net number, meaning the employee doesn't write a check, they just get a net number. So under this scenario, preferred dividends come out first. So the dividends come out, so we've got 17,641,000. We've got to take the preferred dividends off of that number first, and then everybody gets their percentages. So the math does work. But 17,641,950 total available proceeds, I got to take 700 grand off of that because that's, if you will, for lack of a better term, debt that I've got to pay VC Ventures, and then everybody is going to participate proportionally in the waterfall. So what ends up happening here is VC Ventures gets their percentage of that share. Basically, it's, I can even tell you the exact math on it. It's 16,941,950 after the 700,000 comes out. So now that 16,941,000 is going to divide proportionally into the shares. So VC Ventures gets 7.8 million of that. Down here, VC Ventures owns 47.3% of the company, 47.43. They're getting 48.56%. Not too bad, and it's basically impacted by the dividend that they saved the company. And you can see what everybody else, the founders each got $1.8 million. Look at Uncle Charlie. Charlie got $1.35 million. Plains Angels did pretty good. And obviously the key employees did pretty good. Everybody's happy here, you know, and the terms really didn't drive it because we got quick to an exit. It could be even more elongated, it could have been 5-6 years, and those dividends would have been a lot higher. But under this scenario, you can see, well, percentages didn't fall exactly, but pretty darn close. People tracking?
Got a question for you. Earlier you mentioned liquidation preference. Does that also include when the company's sold? Is that also?
That's really what it is.
So my question is this: if a forensic, like if Uncle Charlie had a liquidation preference, what is the order of hierarchy and how that goes? Like, does that supersede dividends? And if it's below dividends, who determines who gets paid in what order? All the sales are really low. The
investment documents would all dictate that. And so if the VC Ventures, if Uncle Charlie did have, God forbid, a liquidation preference, they would trump Charlie's liquidation preference, okay? But dividends and any debt take precedence over any shareholders, any equity owners. So debt comes off first, right? So this is simple as like if you sell a company for $10 million and you have $2 million in debt, your net proceeds are $8 million before you even begin. But we're going to talk about liquidation preference right now. So let's go through the same scenario. Nothing has changed, right? Still 2 years after, there's $700,000 worth of accrued dividends, but this time our offer is only $8 million. Let's see how that impacts. You think it's going to be kind of all along the same lines. But let's look at this. So here's again everybody's ownership. But let's remember what we just said. We just basically said, okay, we have 8 million now. So we have 8.14 total available, 8.14, right? We got to take 700,000 off of that. So I'll even tell you what that number is. I had it in there. Okay, so now that's $7.4 million that we have to distribute. So if I begin to take that 7.4 and allocate that on everybody's percentages, guess what happens? VC Ventures, 46.43%, only accounts for $3.4 million. But guess what they've got? They've got a liquidation preference. They get 1x of their money guaranteed. Now, the first scenario, that liquidation preference didn't kick in because they got like $7 million, and so it just didn't kick in. You know. But this time, they had a floor of 4.5. They were guaranteed that money before anything else came out. So they've got that, they clear out the cap table there, and then basically you take, this is a little complex, but you take their ownership off and then allocate everybody else's percentage there. That's what gets allocated to everybody else. And I can take you all through that math. I'm trying to keep it at some of a high level, but the point being on this is the math didn't equate to the return they were guaranteed when they wrote a check into the company. It was 1 times. You know, if it would have been before that, they couldn't get 1 times, that's still a thing, but they were guaranteed their money out first and at least 1 times. So that's why VC Ventures got 5.2 million. Under this scenario, VC Ventures got 63.87% of the proceeds of the sale and only owns 43.46 or 46.43% of the company. So, anybody have questions on that? And again, it was a term in a term sheet that maybe, you know, hopefully everybody understood when they allowed them in, but it was a protective matter for VC Ventures to know that at least we're going to get 1 times our money back prior to anybody else getting any money back. And that's why VC Ventures probably voted for the $8 million. They got their money back, plus they got $700,000 and they're done.
So just to confirm, the 3,781,791, where did that come from again? Right above the 5.2 at the top?
On here?
Yes, on the far right, there's the 5.2 million VC Ventures got. What's the number directly above that? 3,781. Where does that come from?
That is, I'll tell you exactly what that is. Yeah.
So what?
It's the difference between the total and what was paid out to VC Ventures.
It's what's allocated to the rest of it.
Adds up to the 8 million total from the sale.
But that's 8 million not, right? 3,780,000, whatever, plus 5.2, that's like 8.9, right?
I don't believe so. Is my math bad? I don't have a calculator.
I think the 700,000 is what's missing.
Yeah, possibly. They're still getting 5.2 million. I think the math works. It's probably just more on the actual spreadsheet itself. But I think that they're getting $5.2 million out of that total proceeds. And again, just because they had that liquidation preference, so they got that, they had 4.5 million in, they got their dividend, plus they got their 4.5 back. Okay. So let's go through one more scenario. And what if basically the same scenarios do, dividends exist, everything else, but what if there was one more term in that term sheet? And that term was participating. Participating preferred stock with the 1X. And all that really means is, I get my money back. I guarantee my 4.5 plus my dividend. Plus now I'm going to drop down to the cap table and still get my 46.43% of whatever's left. Because I'm going to participate after my liquidation preference. One word, participating preferred. Same exact scenario, and we can run through this. VC Ventures is still going to get their 5.2, and again, we remove these guys, we remove VC Ventures ownership out of that, and now, you know, Uncle Charlie even lost a little bit of money. But check that out, VC Ventures got an additional $1.3 million because they were participating preferred. They had their 1X liquidation preference, plus they had the participation rights after that liquidation preference was paid. And now VC Ventures on an $8 million sale got 82.02% of the proceeds of the company.
So consider where you're at the point where that's getting negotiated. You have a pitch deck that says, we're going to exit this thing for $100 million. I've got my math showing I'm going to get there. The idea of an $8 million thing is like not on your radar. You run the math on your participating, you're like, cool, the odds of that are like 1%. No big deal, but that one little word dramatically changes it. So you would then want to go to the VC and say, well, I don't want that participating in there because that feels really bad to me. I'm going to say, how likely do you think that is? Because you just showed me models that are going to do $100 million exit at the end of the day. So it's all like the negotiation dance is complicated, but you need to be careful for that. So at least understand the implication of what's being said in the documents.
Yeah, well said, and that's why you have a good securities attorney. Read your documents. People get enamored with the fact that somebody's going to put $2 million in their company. They read the first page of the term sheet, go party, celebrate, And, you know, if you didn't read the other 17 pages is how basically they're going to control all the proceeds of on a liquidation of your company. So again, it's just very, very important to be able to run those scenarios, but also truly understand the investor's rights. And again, what we didn't show necessarily here is, you know, the potential of other investors coming in pro rata, et cetera, all the way through it. A lot of times what can happen too is like VC ventures might even allow the other shareholders to have those same rights. You know, if they wrote new checks coming in on the down. The other thing I wanted to show you is because of, under both of these scenarios, this one, the scenario was still somewhat there where they could get a little bit of return to exercise options, so they did, but on the down round one, the proceeds weren't enough for the other shareholders to even exercise options. So the options, the key employees got none. And again, I would welcome the opportunity to walk anybody through. I have all these in Excel spreadsheets to walk through kind of all the math and all of that. There are so many more rabbit holes you can go through. We didn't even talk about convertible notes that could come in at a 20% discount and all of that, but that's very, very common as well. That, you know, Uncle Charlie could have even come on in a convertible note, or particularly Plains Angels might have come in at they might have put $500,000 in and not priced it today. And under that scenario, it probably would have been good because we had a good step up on value, but a convertible note is such that you're kind of deferring pricing down the road, but you're offering somebody, you know, basically you write me a $500,000 check today. I'm going to give you a 20% discount into the next qualified financing. A lot of times the investors will say, I want a cap on that, meaning I don't want the valuation to run away. We could do a whole session on convertible notes, safe notes, all of that. And they're good, valuable instruments. Not all investors like convertible notes, some do. We've had some now that we're dealing with in a little bit of a struggle. I just did one that had over $7 million worth of convertible notes, and we did a down round. It was very onerous because those convertible, they just kept punting and saying, okay, we'll just raise it as a convertible versus pricing the round. And at the end, it really, really did strangle. So convertible notes are really good as long as you're forecasting to a targeted qualified financing. So, I mean, it's a good instrument. Okay.
Jay, you got a question back?
Yeah.
I did have a quick question on that, was just with, you made a point there, kind of where that company was punting kind of down the road, and they were just raising on a convertible note as opposed to say, or doing price round. So in that situation where company's going well, they essentially continue to raise on safe, but let's say that the investors are wanting to see like what the value of their investment is, but we aren't necessarily having like a proper liquidity event or anything like that. Like, could you, and the other point there would be, we don't necessarily need to raise capital now, but our investors want to know what the value of their investment is. Could you, in theory, just raise like $100,000 just to price the round and kind of set the benchmark for your investors?
Not always. I mean, sometimes with regard to particularly a convertible note, there's a definition. I'll give you a little advice on that too. There's particularly a convertible note. Safe's a little different, but a convertible note says you're going to convert. I can force you to convert based upon qualified financing. Qualified financing is defined. We've had situations where somebody will put in the qualified financing that it's going to be a $2.5 million raise, and that's going to force conversion, right? And they're going to get a discount. There might be a cap on it. The problem is my client doesn't need $2.5 million. They only need $1 million, and so they can't force the conversion. So we're having all the note holders actually redraft and sign and take the amendment to the note because we don't need $2.5 million to get a price round in. So again, just like anything else, have a good attorney and understand kind of what you're doing and read the back pages of even your offering documents or term sheets you get, because generally there is a mechanism that triggers that conversion. You know, and I've seen some where it's just the next qualified price round. That could be 100,000 could do it. You know, you could go raise 100,000 and flush everybody. The thing about convertible notes too, though, is they're interest bearing, right? So some of them are higher interest. So you're accruing interest that you're accruing additional equity you're going to give them. So it's very important to understand the terms of the convertible note as well.
Is that accrue in kind, or are you making actual distribution?
Generally, it's just accruing, and then it's part of the conversion. We got one right now. We're going back. We're calculating interest since 2015. So, yeah, I mean, and so that it's important. And candidly, we see a lot of times too, going off on a tangent here, but also it's your responsibility to accrue that interest on your balance sheet. So I'll step into a lot of companies and all of a sudden they'll be, they had notes since 2018. They might have the $700,000 worth of notes on it, but where's your accrued interest on that? You know? So, you know, and again, that's just another red flag that you're not up to date on what your documents are, what your requirements are. People like Eric will just kind of, his eyes will glass over and we'll say next meeting, you know? I mean, so it's just, again, it's just making sure that you're on offense, you've done everything. That is a very, very common occurrence, is convertible notes are not calculating interest on the valuation. I'll get off my soapbox on that. Again, always keep it current. Supporting legal documentation for every investor on the cap table. Again, it shows summary. It's liquidation rights. It's not percentages, and kind of understand all the terms when bringing on a new investor. I mean, there's a lot of reasons to get excited about bringing on investors, but terms and structure really do matter. I think that's all I've got. You guys are great. Good, great questions. Yeah.
So can you go back to the last slide? When you say
This one?
No. When you say summer ownership, not liquidation rights and percentages, wouldn't, you know, if I'm presenting this in the data room, wouldn't the investor be interested in what the preferences are for the previous investor?
Yeah, I mean, all that's saying is it's who owns what of your company, but not what the rights they have to get whatever proceeds out of your company. So in your data room too, I'm going to want to see your investment documents.
And usually you would see on like an Excel, whatever, you would have a footnote on like what safes and convertible notes you have outstanding, because those aren't sitting technically on your cap table, but they'll, aside from the supporting documents, it's good to be transparent on the cap table with some sort of footnote about what else you have outstanding. At least that's been my experience.
And to that point, I mean, we've had, if you will, Series A investors or institutional investors, venture capital firms. Let's take the scenario that Plains Angels had some preferences or liquidation rights or something. We definitely have gone back to the Plains Angels of the world and negotiated that out of their investment docs because VC Ventures is demanding it. And you know, we've done it. Generally, it's happened. Plains Angels accept. Okay, wow, you're going to get 2.5 million from these guys. You know, okay, we'll give up those rights. But again, institutional investors sometimes, you know, can drive those terms where they would prefer not anybody have the same rights they have, or that they're just up at a little higher hierarchy. So a lot of times we've gone back to prior investors and kind of renegotiated terms under the premise that we have growth capital coming in and everything too. So it can definitely happen. I'm going to stick around just for a little bit. I apologize. I've got some meetings this afternoon, but I think my email's on the materials, and certainly willing to talk to anybody. Like I said, we kept this at somewhat, there's a lot of rabbit holes, each one of those scenarios you can go down. So we tried to keep it as at least somewhat user-friendly as we could. But great questions, so thank you.